What's up guys, Hamilton here, and in this video I want to talk about the stock market's winners and losers of a reopening economy. I'm going to be discussing why I think we could have another crash, as well as sharing some of my favourite names from the long and short side. Some of which I've covered in previous videos, but also some new names, so stay tuned. Welcome back guys. Before I get into the meat of things, a short word from our sponsor.
What's up guys? This video is sponsored by the like button, so please smash that like button. It helps Daddy grow this channel and put chicken on the table for me and my baby sister. Chicken.
Thanks for that, Fuge. Back to business. Ever since the great stock market depression of March 2020 that lasted all of 1 week, the stock market has been on an absolute tear. The Fed's intervention and promise to keep on printing has led to new all-time highs in the NASDAQ and S&P 500, and if you were one of the smart ones that invested your entire net worth into GameStop shares, congrats and f*** you. But jokes aside, it wasn't all rainbows and unicorns. There have been plenty of losers over this past year, it's just that tech wasn't one of them. With the whole world working from home, names like Slack, Netflix and Peloton were just a few of the major winners from shelter-in-place policies. These names had the benefit of accelerated revenue growth throughout lockdown, and investors eyeing rate of change in their financials led to unprecedented multiples for these stocks. You see, a multiple of 80 times profit to value a company is only sustainable if that company is growing fast enough to justify it. And the stock market is forward-looking, so when a company is growing 100% quarter on quarter, what you and I see as an insane valuation for a company might just be a fair valuation based on 2025 expected revenue. There are of course other factors that have led to the astronomical rise in the price of some stocks, but I don't want to get lost in the detail here. What's important to understand is that this kind of growth won't last forever, and there's already signs of slowing growth in some names. As growth decelerates, investors will likely lose confidence in some of lockdown's biggest winners and begin to see through those sky-high valuations. On the other hand, there will be plenty of new winners as the economy begins to reopen. Just as tech companies benefited from glowing comparative financials each quarter, these names will too. Investors seeing retailers going from 0 to 1 in revenue will start to see who the real winners of an economic reopening are. And whilst there may be concerns over how fast things open up, if these names manage to survive until now, I have to believe their balance sheets are strong enough to see them through any further roadblocks from here on out. That said, let's kick off with our winners first. I'm saving the best for last, so stay tuned. Expedia, EXPE. Whilst I continue to be wary of a business travel recovery, there most certainly is pent-up demand for leisure travel. I don't know about you, but I cannot wait to get the hell out of here. And headline revenue growth is going to start looking impressive as the industry compares against near zero hotel activity in the prior year. The leisure customer is coming back and demand is accelerating. Spirit Airlines, SAVE. Here's one I covered before when the stock was trading at roughly $30 per share. Whilst it's now up over 30% and trading at around $40 per share, I still see more upside in this one for much the same reason as Expedia. But I'd let the stock pull back a bit before I buy any more. Brinks Company, BCO. Cash is not dead just yet, sorry crypto bros. Expect shares of Brinks Company to continue to perform well as the pandemic recedes and consumers return to cash venues. Speaking of cash venues, another potential winner here in the form of Madison Square Garden Entertainment, MSGE. Expect demand for events to be through the roof as restrictions loosen up in the coming months. Porsche Holdings SE, POAHY. Another ticker I've covered separately, and I still love this in an open economy. Why? Expect reduced public transit utilization as people are still wary of crowded spaces. On top of this, we've seen a mass exodus of people from urban areas to rural neighborhoods, and whilst this may decline as things return to normal, the average age of consumer vehicles has risen significantly, which would support an impending rise in auto sales. Designer Brands Inc., DBI. Another idea from one of my favourite retail analysts, Brian McGough. Already up a fair bit since I first mentioned this name, but still plenty of upside from here. Whilst online business has kept revenues from going to zero, expect a solid earnings report once stores reopen, especially as people start to return to offices and attend events. I'd expect demand for high-end occasion wear to boost sales of this retailer way beyond analyst expectations. Dufry, DUFN-CH. This has to be the mother of all reopening plays, which I'll cover in a later video. Dufry is one of the largest duty-free retailers in the world. Whilst their current financials look like absolute shit amidst the travel standstill, they're going to look like gold amidst the leisure travel rebound. That's it for our winners, so let's talk losers. First up is Kroger, KR. One of the major beneficiaries of the pandemic, but don't expect this to last. Grocery store sales decelerated at the end of February as we start to approach the 1-year anniversary of the stockpiling and toilet paper hoarding that occurred in March last year. Best Buy, BBY. The company is facing a severe revenue slowdown into the second half of 2021. Domino's Pizza, DPZ. Like many COVID winners, 2021 is going to be a challenging year for several reasons. Pizza delivery plays like Domino's were the only go-to place to eat in the early days of the pandemic. The 2020 pull forward of demand will reverse course in 2021. Stitch Fix, SFX. Their latest earnings report turned out to be abysmal, but there's still a lot more downside from here. This is a completely broken business model that's exhausted its total addressable market for its core business, and in a bid to meet investor expectations has branched into clothing e-com. Valued like a tech company but run like an e-commerce store, things will only get worse when things open up, and it's competing against retailers. Okay folks, look who's back, our sponsor. Those are our losers. Bear in mind that this is far from an exhaustive list, and there are plenty more names I love and hate. And I'm still very bullish on companies like Ouster, ASPL and Blade. That's all from me today. If you enjoyed this video, please smash that like button and leave a comment below to let me know which stock is your favorite. As always, don't chase the FOMO, be a smart investor and buy the damn dip. That's a wrap!